Hey everyone, welcome to the KE Report Daily Editorial on Friday, November 7th, chatting with Marc Chandler. Marc is a managing partner at Bannockburn Global Forex, also the editor of the Mark to Market website, which I will post a link to in the show notes. Marc, let's start off with US markets. Going through a bit of a correction here. The last few trading days, really the last about week and a half, these markets have rolled over. The S&P was over 6,900 and now it's down to about 6,600 and change. But fact of the matter is we've seen a general rollover after those all-time highs. We're not back to recent higher lows, but we're seeing the VIX, that's back over 20, and weakness in a lot of different sectors. So, Marc, your takeaway, what's standing out to you with this, let's just call it a correction right now for the markets?
Yeah, I'd say a couple of things. One, it seems to me that still the sell-off seems to be highly still focused on like the tech sector. I know it's spilled over a little bit, but other sectors have been holding up fairly better. But I just want to say about we oftentimes people like myself we're looking at macroeconomic factors, but sometimes there's some technical signals. And what's happened, what strikes me, is that the S&P futures, when I should say S&P in the cash market, when back in April when we were selling off and people start saying that the whole world was boycotting the U.S. The S&P gapped lower 3 days in a row, and it sounds kind of old school and everything, but it's like it's in the like our literature, the traditions of the markets. Three gaps is an important rule, and at the end of October, the S&P gapped higher 3 days in a row, and that tends to be a sign of exhaustion. And so I think that this was like maybe like that this last leg up was an exhaustive part into the end of October, and then we had this fundamental development where the Fed cut rates, but made it sound like maybe December was not a done deal, as Powell said, and so that we had a backing up of interest rates coinciding with this pullback in stocks. I think it's going to be noteworthy if we really get below 6,600. Where do people first try to buy the dip? And remember that October low was about 65.50. So that's about 100 points from where we're trading ahead of the weekend.
Well, Mark, just to the point you just made, sometimes there's a divorce between what's happening in the market and what's happening in the economy, too. There may be certain macro signals that we're all looking at and talking about, and the market may be ignoring them, which it largely has. You could argue there's been some negative things where the market should have sold off harder and it just kept powering higher. And there's times where the market's pulling back, even if some economic news may be improving. So, how do you square that circle between what's happening in the macro between the Fed and what we're looking at as far as more rate cuts coming and market expectations, but also the limited data that we are getting with the government closed? How do you square the circle between the macro and the market?
Well, I think that so when I look at the dollar, look at the stock market, I still see a strong, it's not 100%, of course, but there still seems to be a strong relationship on a day-to-day basis. And it's really not just a small moves, right? There's like, if you think about like what it can move, say the standard deviation or volatility, it can move, it can move around a little bit without really signaling anything. Sort of like when we're driving our car, or you can turn the steering wheel without the wheels really turning. There's a little bit of a little play there. And I think the same thing here. On big days, stock market either drops sharply or we see go through key levels. Treasuries tend to catch a bid. And so I think that there's a relationship, of course, between these different parts of the capital market, but the relationship's not always linear or easy to figure out. But I think that the backing up of interest rates and what's really going on too, and we see this in the currency markets where the Canadian dollar, Australian dollar, New Zealand dollar have been underperforming. These currencies are sort of levered towards world growth. And the stock market's been selling off as we get, we had a bad challenger estimate of job layoffs. We've seen some weakness in PMIs, ISM, some of these, as you mentioned, without the government open, we sort of have to rely much more on these other data points. The ADP came in a little bit stronger than expected, but if you give me the past 3 months, we're flat. And so I think people are still concerned about the length of the shutdown, what it means for the economy. A rule of thumb is that for every week we lose about 0.1% of GDP. So we're looking at something like at least zero point 0.3, maybe even a little bit more than that, if you think that we can reopen before Thanksgiving.
So, Marc, look, all we're hearing about right now in the media, or a lot of what they're focused on, is this government shutdown. And quite frankly, Shad and I just flew back from a conference in New Orleans, and A lot of people were talking about if their flights would be canceled. We are starting to see flights being canceled and people simply just not showing up for work. And then, besides the government shutdown, a whole lot of news on AI, bubble in AI, and if the government would support any companies if that bubble popped. And right now, the government's saying they will not be supporting. And we're seeing AI and tech stocks lead this downward move in markets. Balance these two out, I guess it does make sense that the markets are moving lower, but where's the clarity on this?
And I think you're right. I think that many people recall the last time we had this long of a shutdown in Trump's first term, and many people, part of the folklore is that the air traffic controllers, if they're not 100% in their game, if they can't operate at 100%, they probably should be staying at home. And you just think about how these people, the stress and pressure these people have to work. Plus, now you say they have to work but can't support their families. They're not going to get the paychecks. And then we got this whole thing with the Supplemental Nutrition Assistance Program, SNAP. Something like 40 million Americans need help. And out of that, it's like 20% of that or so are children. These are like people who are elderly, people who are sick, people who are, and like I mentioned, children. It's just like something like 10% of the people who get this program in the U.S. are working. It's not they don't have a job, it's just that job doesn't pay well enough. And so I think that the longer this, we've already seen, as you mentioned, starting today, we're getting a slowdown. That is a cut in flights from some major cities, major airports. It's gonna reach 10% after the weekend, and that's only the first part of it. But I think that these kinds of things and the unpopularity of this government shutdown, I think is another thing that the administration wants to like just get over with because it really freezes up everything. And so I suspect that we're already finding that there's like talks going on, some kind of face-saving compromise for both sides. So my guess is that as we sit here on the 7th, that we have say 5 to 10 days left before the government opens up. But I think that we're finally beginning to see light at the end of the tunnel.
Well, Mark, you had brought up the U.S. dollar and one of the examples and just how that's closely correlated to the market. So, if we just dive into the dollar, we hear a lot of people on the bearish tilt that are looking for the dollar to keep pulling back over the medium to longer term. But it has had a bit of a rally, and it's just funny. I was mentioning off mic that I started receiving things in my email inbox talking about the dollar wrecking ball again, and that made more sense at a $120, but not at $100, not at a 100 point dollar. So do you think that this bounce that we're seeing in the dollar is just that, a bounce, or do you think this is the beginning of a trend higher in the dollar?
Yeah, no, I'm still bearish to dollar over the medium term. I mean, I think that, but I think to your point is that the bear story on the dollar is really a first half story. Dollar yen bottoms in April. Most of the other currencies bottom late June. The euro doesn't top out till September 17th, when the Federal Reserve cut rates for the first time this year. So I think that what happens is in the first half of the year, say, I see the dollar index itself, even though it put in that low on September 17th, it was only a few ticks more than it was at the low that was set on July 1. So I think that basically the first half of the year, rather than this being some kind of capital strike against the United States, really was people adjusting to the new president, the new administration, and rather than sell U.S. assets, it looks like foreign investors hedged their currency exposure. And then as we get into the second half of the year, I think that we've seen this a correction, and I'm really watching these levels. And you don't really see it so much on the dollar index because partly of the role of the yen in the dollar index. It's not that it's a large weight, but some big moves. But broadly speaking, the other currencies have retraced, say, roughly half of what they gained, say, in the first half of the year. Sterling, for example, well, we held 130 today, not today, but this week, and 129. I think it says 65 or something is the halfway of this year's range. The Canadian dollar, we got up to 140, 140, and that 50% retracement is 140, 160, 65, something like that. And so I think so far, I think this can be explained. Technical correction after a big trend down, like an impulsive trend down, sharp trend down in the dollar. We get this technical bounce that was supported by fundamental factors. And those fundamental factors, I think the key one is that the Federal Reserve has pushed back against how aggressive the market was pricing in their rate cuts. And when the Fed met in late October, the market was pricing in about a 95% chance that they cut rates in December. And after the pushback, and not just from Powell, but especially from Powell, the market's at about 2/3 now of a chance. I think that's still a little bit high. And so it seems to me we could come back down towards, say, 50%. Seems more reasonable to me, and it could give the dollar index one more little leg up. But what I think happened too is where did we stop on the dollar index, the 200-day moving average? And so if we were to get above that 200-day moving average, it now comes in around par 26, par 25, I should say. That's really the high from August 1st. So if we get back above there, I'd say, okay, we get one more leg up, and maybe it goes to 101.5 or something like that. But I think in the big picture, the Federal Reserve cuts rates more aggressively next year than other central banks. And I know it sounds kind of simple, and it doesn't work in a straight line, but generally when the Fed is cutting interest rates, the dollar falls, especially in the early part of the cycle.
Yeah, so interesting to see that dollar peak exactly at that 200-day moving average, which in all fairness is coming down pretty hard. So, Mark, you tie in Fed policy. What about, is there a potential here that if we all think this government shutdown is going to end, it could be a bit more of a reason for investors to buy stocks and even buy the dollar, since that risk or this ongoing kind of torture that we're living through, at least in the US for those government workers, is over?
I don't know. I think that there's going to be some catch up, but I think there's some permanent damage being done too. So, and I think it gets overwhelmed by other factors, whether it's the December Fed meeting, where they hint at further cuts. Maybe it's the politicalization of the Federal Reserve. I think there's other things like in the pipeline, and I think that we're going to get some very weak economic data as when the government opens up and begins collecting that data again. So remember, even if the government were to open up tomorrow, it would still be several weeks before we get any credible economic data.
Well, Mark, is there any data that you're using outside of government data that you think is a little non-traditional, but I know you look at a lot of different factors that you think is a good guiding stone? Also on the job side of things, like it seems like there's a lot of concern over a continued loss of jobs. Anything else you're using as a measuring stick?
No, I mean, we really limited, I think, because some of the companies now that want to like move into this field that has been vacated with the government shutdown, we haven't been able to test the data. We don't really know how well it matches up. I think that one interesting thing is that usually on Thursdays we get the weekly jobless claims, but those are really generated by the state, by the individual states. So what happens is that they're like aggregated. But so there's people who are looking at the state data and aggregating it themselves. And so we do have like I think pretty good estimates for weekly jobless claims. I think my sense is that for a long time we've looked at things that weren't really traditional data, corrugated cardboard, railroad car fillings. What I'm looking at is, and it partly fits into like Dow theory. I'm looking at a real drop in Chinese cargo ships to the U.S. I'm looking at a real slowdown. I think about almost a 15, 17% decline in truck traffic. And because that's how we move around things within the country, railroad or trucks. And we're seeing a slowdown, and it does concern me that the economy wasn't that strong to begin with. I know we had what it looks like the optics, strong economy, but so much of it seems to be from the AI and that construction sector, building these data centers. And it seems I don't know, from the outside, it seems like one company giving money to another company, and they sort of like pass that money around, and somehow this boosts GDP. So I think that sort of like the stock market, we'd say, right, that there's 7 companies or so that have been really leading the way, and there's a lot of stuff below the surface, a lot of companies that can barely service their debt. And so we'd say that, like a sort of two segments to the market. And I think the same thing's true with the economy. Part of it looks very strong, but there's other parts, especially the household sector, consumers, commercial real estate, this transport, which fits into the Dow theory with, the industrials and the transportation index. So I just think that it's a very tough time, but I think that policymakers still have to act. And what that might mean a December cut, I lean against it, but I think that there's enough information from these other reports that the Federal Reserve can still have a handle on the economy.
Isn't the other thing globally the fact that a lot of other countries are also struggling? And as much as we all think the Fed will be cutting more than other central banks, what if some other central banks actually pivot because their economies are struggling?
Yeah, I think you're right. I think that, I mean, my sense is that's what's going to happen. For example, the ECB has suggested that they're done cutting rates. And I think that a combination of factors, their own economic weakness, deflationary forces, I think we might even see that before the end of the month when we look at the wage settlements. So yeah, I think there's probably scope for central banks, including in Canada. The Bank of Canada makes it sound as if they're done cutting, but I think that we could still see another cut. The Bank of England's got maybe two cuts left in the cycle. I think it'll be interesting what happens in December in Japan. They didn't hike rates at the end of October, like some people had thought previously, but it does look to me like, with given the weakness of the yen, that they could hike rates in December. The problem is before they get to the December meeting, they're going to get Q3 GDP, and Q3 GDP looks like it contracted. So when U.S. Treasury Secretary Bessent sort of complains that Japan is not raising interest rates, part of it is that the economy looks a lot more fragile than it might seem.
All right, Mark, we'll wrap it up here. A lot to take in, even without this government data. But look, confidence is definitely dropping. We keep seeing all those headlines. Just how I think upset and disappointed U.S. citizens are that this is continuing, even those that aren't working in the government sector. But markets, now that they're correcting, we'll see how low they go. And then we'll also need to pay attention to what Trump does, because at any time, his tweets can also turn these markets. We'll just see how much everyone's willing to weather a correction in these markets. Again, Marc Chandler, managing partner at Bannockburn Global Forex and editor of Mark to Market. We'll post that link in the show notes. Mark, thanks again for your time. Hope you have a great weekend.
Thanks. Good luck to everybody.